Bismillahirrahmanirrahim. Hi guys, how are you? Hope you are fine. Well, in the last video we learned about the discount rate for a company, right? What is cost of equity, what is cost of debt, what is WACC, and we touched about something called risks, business risk and financial risk. So, in today's quick concept video, we will learn about business risk and financial risk. Okay, now in the last class we discussed that KE is greater than KD, right? And why is that? Let's find out. We said that the shareholders bear more risk. Why do they bear more risk? We'll get to that later, but let's study a little about business risk and financial risk. What are business risks? Let's see. Okay, they are related to business, right? The name suggests that also. So, taking the examples, sale price risk. Now, why would be the sale price be a risk? It will only be a risk if the sale price goes down. Yes. If the sale price decreases, that is a risk that your revenue will fall. Now, similarly, looking at the cost price risk, if the cost increases, that will also result in greater cost and lesser profits. Similarly, exchange rate risk, if you are indulging in exports and imports, there will also be a risk. Then risk of fire, your premises may catch fire, or if you are in an area that is prone to floods, there is a risk of floods, etc. You can name many more risks that may be applicable in certain scenarios. Then there is also a risk of IT, cyber attack, hackers, right? Someone may steal your data, right? So we get a concept of what are the business risks. Okay, so moving on, financial risks. Okay, in the last video we learned that the company has a cost towards the equity holders and towards the lenders. So taking that concept a bit further, so that means that the total company's capital consists of number one, the equity, and number two, the debt. Okay, so if we consider that the total capital of a company is about 100 million and 60 million is equity and 40 million you got from the lenders, so 60 plus 40 comes out to 100. That also means that 60% of the total capital is financed by the shareholders and 40% is financed by the debt holders. So that gives us an equity to debt ratio of 60 to 40. That is how a company is financed. Yes. This is also called the gearing. How much a company is geared. The more the proportion of debt, so you can say that equity to debt 60 to 40, or another company that is equity to debt ratio is you can say the reverse. Equity is just 40% as compared to this company where equity is 60%. So which company is more geared? The answer is this. You compare the debts ratios, 60% debt is more geared than a 40% debt company. So it is also known as the gearing risk. The more the company is financed by the debt holders, the more it will be prone to financial risk. Okay, moving on. We learned that in the last lecture that KE is greater than KD. Now question arises, why is that? Let's take another example and that will clear up. If a company has a profit of 100 million, of course I refer to profit before interest, and another company has, it's the same company, but we take first year, it's had profit of 100 million, interest of 20 million. What do we have left? 80 million. Now shareholders can enjoy this figure. But if we take the second year into perspective and we take a profit of 70 million, probably in the first year there were not many business risks. But as we move on to the second year, company has some risk, right? Their product may not be so much popular because it may be obsolete, or maybe there may be some other risks. They were not able to produce many units in the year, so they were not enjoying this much profits in the second year, and so company only made 70 million of profits. So the lenders are not very kind. They say that we have given you a certain amount of capital and we expect that you pay us first and you pay us the complete amount. We will not forgive you for making less profits. So they take the whole 20 million in the second year once again. So that leaves only 50 million for the shareholders. So you see, when profits declined from 100 to 70, the lenders did not want to participate in that loss or the loss of profits, right? And ultimately the shareholders have to bear all the decrease of 30 million. I think this example easily clarifies why K is greater than KD, and that is why shareholders demand more cost of equity from the company, because they know that in any sort of any instance of uncertainty, the lenders will not be cooperating with the company because they demand a fixed return, right? And shareholders are the equity holders and they are the owners of the company, and they have ultimately the responsibility to share the risk, right? In this case 30 million. So since we saw that lenders were not willing to share the loss in profits, and why is that? Because by agreement they are bound to a fixed rate. For example, 5% or 10% or whatever the figure is, they are not willing to share in the losses. But it goes both ways. If a company makes higher profits, the shareholders will enjoy it. This is what we call the risk and return relationship. So another feature of cost of debt is the security. Yes, they may have some charge on the assets of the company. They secure themselves, right? And third thing is the liquidation and winding up. In case of liquidation or winding up, who do we pay first? The shareholders or the lenders? We always pay lenders first, and they have a priority against the shareholders or the equity holders, right? So this was a short concept on risks and who bears those risks. We saw that it was the shareholders that ultimately had to bear the risk. So that is why cost of equity is higher than the cost of debt. Thank you guys. I hope you like this video. If you like it, I request you to share it. I would request you to wait for another video. So if you enjoyed it, do share it with your friends and others, so everyone has an access to easy concepts. The life is so fast today that we cannot wait for 2 hours or 3 hours or 4-hour lectures to just grab a simple concept. So it's pertinent that we learn through short videos like these. So if you like it, then I'll see you in the next video. Till then, take care.